India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Tuesday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Overnight, not very much. This morning in Asia, a fair bit. That's the best way, I think, to put it. We'll get on with it and we'll tell you what's important as far as markets are concerned. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. Surabhi and Nigel with me. Guys, hi, good morning.
Hi, good morning. And I guess markets are still in feel-good mode because we have more central bank action and despite everything that's happening in the Middle East, and that really was catching my attention because at a human level, things seem to be going a little haywire over there. But at a market level, I think, it's still the party going strong.
I mean, party is going absolutely strong. No two ways.
Well, that's right. And today, for the first time, we're going to go to 26,000 odd. You know, I wasn't here in 2008 and 2009, but you all would have seen 2,600 as well. And today, 26,000 odd. So it's going to be a bit of a landmark.
Absolutely. Although I would say that, anyway, I'll tell that story. It's too early in the morning to tell old stories.
I'm all yours already.
Okay, anyway, so let's rewind the clock back and tell you what you need to know as we begin today's session. You've got basically a very, very lackluster overnight day, right? Nothing. S&P was up about 0.25%. NASDAQ was up about 0.14%. So these are nothing kind of changes. Volumes were muted. So if you look at the NYSE, compared to the 20-day average trading volumes, they were down about 10%. No big directional drivers. There was lots of Fed speak, which I'll lay out in a bit. 10-year was unchanged, 3.75. The dollar index at about 101. You had the U.S. manufacturing PMI numbers, which came. They were soft, but not soft enough to invoke fresh growth concerns. Actually, services PMI, which is more sticky. Actually, services inflation is more sticky. But the services part, which is the larger part of the U.S. economy now, like most countries, that actually was much better as compared to the manufacturing side. I said lots of Fed speak. So we had Fed's Goolsbee, who said that rates still need to come down significantly. Bostic and another gentleman said that 50 basis point is not the template for future cuts. So they kind of echoed what Powell has said, that don't take every meeting to be a 50 basis point meeting. Oil cooled down a little bit, down about 0.6%, at about 74. So that's essentially what happened, or what did not really. It was very, very quiet. Let's put it that way. And, all the headlines are the Middle East, and Surabhi will talk more about that in just a bit. In terms of actual price movement and price action, did not amount to very much. Oil actually ended slightly lower. Just to circle back the levels for the Nifty, the question is, will 26,000 act as a bit of a psychological resistance for the market? It's possible that it does so, but logically, the next targets that you got to look at, and the way to do it, because you're in blue sky territory and the market can go anywhere, is essentially to look at, for example, 26,245 is the 100% projection of the last move that we had. So that's the first target for the Nifty, which is 26,245 once we take out the 26,000 levels. Now, on the downside, we must not break the 40-hourly exponential moving average, which is about 25,586. And that must be respected. Bank Nifty has gone up for 8 trading sessions straight. So it's been a very, very strong market for the banks and financials index. It's been the underperformer, made new highs fairly recently. So there is room there. In the near term, the Nifty Bank can move to 55,615. That's the first level. Let's get there and we'll talk more. On the way down, the important support, again, like the Nifty, is the 40-hourly, which is 53,080. So these are some levels that I wanted to put out. I mean, it's looking a pretty decent kind of a day with, of course, help coming in from China earlier today. GIFT Nifty will come up on your screen. It's indicating about a 65-watt point higher start. Surabhi.
Absolutely, Prashant. Because of China's moves, I mean, all of Asia is a nice shade of green throughout. Two major central banks that we're talking about over here. First, the PBOC. Now, the interesting aspect was that there was actually a press conference, which usually never happens with the Chinese central bank, but maybe they took a cue from the Fed. It is, of course, a season of big central bank moves. So what do we know? the PBOC has done a couple of things. One, they've lowered the reserve requirement ratio by 50 basis points. The governor in that press conference hinted that more cuts are coming on different parameters. He said that there could be another 25 to 50 basis points that they do on this RRR by the end of the year. Not just that, he also hinted that the loan prime rate, the 1 year or the 5 year, I mean, didn't indicate which one, but they could also be lowered by 0.2% to 0.25%. And that's the benchmark rate when you're talking about Chinese monetary policy. The 7-day repo was also lowered. So lots of easing from China with promise of more, and that's really powered up not just mainland Chinese markets, but Hong Kong and, like I said, the rest of the neighborhood. We'll also have the Australian Central Bank come out with its rate decision today, and no change is expected over there. Quickly moving on to geopolitics. Now, you would have been watching the news overnight, and those headlines are getting more and more dire because just in terms of the human cost, we're talking about almost 500 people perhaps reportedly killed. 492 was the last figure that I checked, in various sources. Over 1,500 wounded. But none of this has actually led to a move on oil, as Prashant mentioned. Very range-bound, though there's a bit of an upbid once again this morning. Oil prices are up about 0.5%. And gold also seems to be reacting more on the stimulus and the fact that there's so much money in the market, maybe more than the tensions in West Asia. But for what it's worth, we should also bring up the price of gold because it's just moving like a rocket. 2650 has already happened on spot gold. That's how quickly the gold markets are reacting. And of course, oil continues to be in a range, but the bias is on the upside, closer to 75 on Brent. Back home, well, no problems here whatsoever. The rally continues to cruise along. However, we had another caution coming in from SEBI. Their latest report, remember the first one caused such a flutter, caught a lot of headlines on the F&O market. Well, they've come out with the latest study, and this talks about FY24 as well. And the numbers have only gone up. They're saying 91.1% of individual traders actually end up losing money in F&O. That's what happened in FY24, and 93% lost money if you're looking at FY22, 23 and 24, all 3 years put together. And SEBI is saying only 1% of the individual traders managed a profit of more than 50 lakhs. And actually, while a lot of individual traders kept losing money, it's the institutions, people who are running their prop books and institutional investors, they are the ones who managed to end up with some gains. So anyway, let's see. That's a bit on the sentiment side. Quickly coming to the fund flow picture. We don't have a massive FII buy number like we did on Friday. Yesterday's buying was a little more measured, 400 crores. Domestic institutions were also on the buy side. Short point, the Qs are positive, whichever way you look at it, and the flows are coming in. So, Nigel, who's to say? Who's to stop this party?
Well, that's right. And the rollovers are picking up as well, getting into the monthly expiry that plays out later. And the rollovers, if you compare it to the same time of the last series, the previous month, well, it's a little bit higher than what we have seen. Today, you have the Nifty Financial Services Index that will play out its weekly expiry. And the client, as well as the FI positioning, well, they're on the opposite ends of the spectrum, which I'll get to in just a bit. The Nifty moved up yesterday, but the VIX as well is creeping up. And sometimes that indicates a bit of caution in the near term, or some kind of consolidation is what we could brace ourselves for. You could argue that the VIX is bouncing up from bombed out levels, but it's bounced close to around 15% from the recent lows or thereabouts. What do the FIs do? They added 12,000 long, 12,000 short contracts. They continue to remain net long, with close to 75% of their positions on the long side. Let's pull up both the client as well as the FI positioning. Now, the clients are net short. That's the highest we've seen in the last 2 months. The FIs are net long, and that's the highest we've seen in the last 2 months as well. And sometimes you see when this sort of a picture, plays out, you could see some consolidation or maybe a minor pullback as well. So we'll have to keep an eye out on that. The PCR I mentioned yesterday had moved to the upper end of the range. It's still hovering around 1.4 odd, which is still towards the upper end. Options data comes up for you on the screen. The call writers, they seem to be trying to protect higher levels. Let's see if they get stumped out on the wrong side, because both those two calls were fairly active in yesterday's trade. The 26,000 mark, well, that's there today, and we could see it in the first few minutes itself. But I think at around 26,050, well, that's where we could see some resistance going by the options data. Support comes in at around this 25,700 odd, but the markets are firmly in an uptrend till the near-term line in the sand, that's a 20 DMA, does hold out. Moving to a couple of other data points, the Nifty Bank, that's found its form. In the last 1 year, it's actually been a bit of an underperformer. In the last month, last week, it's actually been the outperformer. And that needs to lead from here on if the markets need to trend up. The sector that I'm looking at besides the Nifty Bank is going to be the metal index, because of the commentary coming in from the PBOC chief, as well as the other comments that come out of there. Supported for the stock market, supported for the economy. If that's the case, then the metal index is something you keep on your radar. And two stocks I'm looking at. RBL Bank, it comes out of the F&O ban, so we keep an eye on that one. And VIP Industries, influential investor Mr. Kedia has checked in out there, been a rank underperformer if you compare it with what it's done with Safari. And also they have a couple of big investor meetings that are lined up later this week. So VIP Industries, after a big underperformance, it's another way of playing the travel and tourism theme. So let's see how that goes. We'll keep an eye out on this one from here on.
Yes, that's a very interesting check-in to VIP. Nigel, thanks for putting that on the radar. So definitely a stock that we'll watch out for. Well, let's kick off the proceedings with the equity call of the morning. Herald van der Linde of HSBC believes that India continues to offer a strong and stable earnings growth story. He says demand from domestic investors provides liquidity and limits downside. But cracks are emerging. He adds banks are struggling to hold on to deposits as everybody flocks to buy stocks, and this impacts their earnings. But this will not derail the market yet. Herald says foreign funds are at a record high underweight on India.
All right. Well, there is a lot to track, so let's get the first opinion. And Neeraj Seth is CIO and head of APAC Fundamental Fixed Income at BlackRock. He's with us here in our studios. Neeraj, great to have you with us here. Thank you very much. And always good speaking face-to-face. So how are things looking, Neeraj? We had that big rate cut and markets have moved on. Are we starting a fresh leg higher? How would you describe it?
I think we are seeing the tailwind. And the big point here, because the markets are now in the debate of 25, 50, and we'll look back in time and say the more important point was that overall tide of the rate cycle had turned, which is very, very clear. So Fed is going to be easing from here. You still have probably another 150 basis points to go over the next 12 to 18 months. So from the overall economic perspective, if you think about it, US is moving towards a soft landing with lower rates. It's still a positive for risk assets. So I don't see a lot of risk in terms of the headwind at this point, unless something changes, whether it's geopolitics or US political standpoint. But for now, things are looking good.
There is no chatter. I mean, that is given. Soft landing is now it is the consensus, but there's no chatter about why GDP is still expected to grow at 3%. Stock markets are at new highs. Credit spreads are tight. I mean, so why 50 basis points? There's a large cut. So there's no question around that?
Well, first of all, if you take a step back and think about where the Fed is from a real rates perspective, it's probably the highest we have seen in a very long time. And given the economy is slowing down, the unemployment is inching higher, the Fed has to bring the balance back in their equation of dual mandate of price stability and the full employment. So from that angle, it's more of a balancing move to bring the neutral rate back in equation rather than keeping the rates at a level where the real rates are very high. So I don't think it's a panic move, just to be clear. They could have started in July, bit of a catch-up.
You know, I was exactly thinking this. You read my mind, Neeraj, because it almost sounds too good to be true, because you have markets at all-time highs. You have a central bank that's moving ahead of any major financial crisis or economic shock. Elevated markets, cost of money getting cheaper, soft landing. It's very golden Goldilocks, right? What does that mean? I mean, how much higher for markets then?
So I think markets, from an equity market perspective, maybe you don't have a huge amount of runway similar to what we had in the last few years, because the Fed is still contracting the balance sheet. So if you take the equation of the Fed fund rates and the Fed's balance sheet, that is a combination of the two tools from a monetary policy perspective. But one more thing which people sometimes miss is the fiscal side. You still have fairly high fiscal deficit in the system, which is actually still going through generating jobs to some extent, obviously increasing incomes, and the liquidity in the market is still high. So yes, the markets still have potential upside, but I don't think it's as much as what we've gotten used to in the last few years.
You want to put a range to that? I mean, maybe for the US and then for India as well, but just a rough range of how much higher, given that we're at all-time highs already.
So it's always very dangerous to put ranges on the market, because I know I'll be wrong. We'll look back. But if I have to take a view, I think rather than having 15, 20% up, you're probably looking at more single-digit returns in the next 12 to 18 months, because the economy is going to slow down. I think that's also evident. Yes, the current data is showing strength, but we do need to be mindful of more medium horizon drivers of the economy, and that is gradually slowing down.
All right. Hi, Neeraj. Good to have you in the studio. What about the Chinese market? You know, the policy measures or the sound bites that are coming out of there this morning seem to be supportive for the economy as well as the stock market. That's the bombed out one. We have heard this before, but now it seems that they have some focus on there. Do you think the Chinese market from these levels could relatively outperform Or do you think we've given them their chances, earnings visibility is not there, policy is not really played out, you'd rather stick to a market like India?
So what the Chinese regulators have done in terms of the reserve ratio requirement cut, which will release roughly 1 trillion renminbi of cash in the system or liquidity in the system, as well as the reverse rate cut, the key here is what they're doing is mainly focused on protecting the growth target. If you looked at the data that came out in the last few weeks, it was very clear that the 5% growth target for this year was looking difficult. Now, from a market perspective, I would argue the more important challenge facing the market is the sentiment. Alongside, obviously, the earnings growth visibility, the foreign capital leaving the market. But from a domestic perspective, the consumer sentiment continues to remain at the weakest level we have seen in decades. And that's driven more through a combination of the wage deflation in the system and the ongoing real estate weakness. And I don't think we're at the end of that real estate cycle. So would I be structurally changing my view? I don't think so.
And I think they're saying, did they say they're cutting? They cut or they're saying to cut?
They've cut.
I saw there's 2 cuts.
Yeah, so they've cut by 50 basis points on the reserve ratio already, and they're saying there could be another 25 to 50 basis points going into the end of the year. Very similar to the Fed, holding that press conference saying this is what we've done and we'll probably do more.
By the way, there is a Bank of Japan press
Yes.
conference as well. Any thoughts since we're talking central banks?
I think Bank of Japan is very important, but given a combination of obviously what happened in August in terms of the markets post the last hike, and we're still very much having the LDP elections later this week, I think for now Bank of Japan is potentially on hold. I do think they will try to hike further, but it's not coming in a hurry. The experience in terms of the tightening of financial conditions in August did actually put a pause on their thinking of going aggressively with regards to normalization of policy.
And Neeraj, just to finish that point, India continues to outperform China even from here on?
I would think so. And again, I can't say for next 1 month, but if I take a 5 to 10 year view, I think the structural story, and if you think about the combination of secular, structural, and the cyclical factors, they're all lining up in a positive way with the geopolitical tailwind. I do think the potential for markets, specifically the higher quality companies in the large cap space, I think there's still runway.
You know, I spoke with Jamie Dimon of JP Morgan yesterday evening, and I was asking him whether about this India-China question. It was interesting because we talk about it in terms of financial markets, right? But the larger point is government to government. There seems to be like this break in relations between the US and China, and that seems to be, I mean, the sense I got from that conversation. We'll play out sound bites at 8:30. Is that it's kind of in a way irreversible. I mean, they're on opposite ends of the spectrum, as he put it. And, so the rise of industrial policy, I mean, industrial policy dictating where businesses should go. In that sense, I think India seems to be pretty well placed, right? As opposed to China or other markets in the region.
It's India's time, and all you want is we don't do a self-goal. I think otherwise things are looking good. The economy is on a great trajectory. The infrastructure bill, digital, hard infrastructure, I think it's all very well aligned for structural growth story to stay for a while.
And what would you buy here? That's the troublesome question, right? When valuations are elevated, so much money is hitting the market.
So I'll start with what I would be cautious on. The small mid-cap, I'm getting more cautious given what we have seen in terms of the rally. What you will buy, I think the whole energy transformation story, the new energy sectors, they still have a long way to go. The government target of 500 gigawatt by 2030, even if we don't get there, think of the growth trajectory that is required from here to 2030 for that. So that actually is an interesting sector. There are pockets of retail and consumer where you do see value. Banks, I'm getting closer to neutral because we've seen the best of the credit cleanup behind us, although I don't think we're at the beginning of a new credit cycle in terms of NPLs. But you're seeing some challenges in terms of loan to deposit ratios, deposits really in deficit. So I think there are sectors which are still in a secular trend, and you still want to be actually long in those sectors.
All right, Neeraj, thank you very much for joining us. Great speaking with you, and thank you for dropping by. We'll take a quick commercial break here. We're going to come back. Lots of stock-specific action on the other side. Our research team joins in with that. So these are the stocks you'll hear on. Bharti, Firstsource, Pondy Oxides. Don't hear that often on the list. Reliance Power, GR Infrastructure. And we'll also have names like PNB, Spandana Spurti, which are expected to open in the red. Stay with us. We are back.
Welcome back. So the cues are positive and we're just about 60 points away from the next milestone. That's the implied open. Tells us that that gap could take us closer to the level of 26,000 on the Nifty. So, of course, we have our eye on the overall market, but also individual stocks. And for that, as always, our team is standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off with Bharti Airtel. Vamakshi is watching out for this one. Vamakshi, morning. What's the news?
Well, good morning, Surbi. Bharti Airtel will be in focus today, and on the positive side, and that is because the company has erected 1,700 towers in 7 months. Now, roughly, this pace equates to nearly 8+ new towers added daily in Gujarat. And in fact, with this, they've bolstered their network infrastructure across the state of Gujarat. They will be expanding its coverage to 7,000 villages across the state, and they aim to reach nearly 5 million+ people in Gujarat. So this bodes well for Bharti Airtel, both in terms of subscriber addition as well as some bit of positive could come in as far as the market share is concerned.
Okay, all right, Vamakshi, thanks a lot for that. Well, let's move on to Vivek, who's here to tell us about PNB's QIP. Morning, Vivek.
Well, good morning. That's right, a very important development as far as PNB is concerned. So yesterday the bank launched a QIP, and this particular fundraise is they're looking to raise close to 5,000 crore rupees. The base size of the issue is 2,500 crore, and the upsize option is another 2,500 crore. Now, when you're talking about the indicative issue price, it is seen at close to 103.75 rupees a share, almost a 7% discount to the current market price. And if you take into consideration the upsize option, it's almost a 4.5% equity dilution from the current equity base. Now, what is it that the company is raising funds for? Number one, to augment the Tier 1 capital, and number two, for growth capital. So watch out for PNP, given the fact that it's at a slight discount. Expect the opening to be in the mild red.
Okay. All right, Vivek, thank you very much for that. Let's talk about more stocks with news flow. Vamakshi is here with those. Vamakshi, morning.
Well, good morning, Prashant. Let me first start off with FirstSource Solutions. Its arm, FirstSource Solutions UK, will be acquiring 100% stake in Ascensos, and this is for a consideration of nearly 42 million GBP, or roughly around 468 crores. Now, keep in mind that Ascensos generated a turnover of 64.1 million GBP in 2023, which roughly puts the price to sales ratio at 0.66 times. This acquisition will allow the company to expand into retail verticals, strengthen its nearshore as well as multilingual capabilities. Keep in mind that the retail and CPG BPO market is a $20 billion opportunity globally, as far as the company has said, and given those details, expect the stock to open higher. Spandana Spurti, on the other hand, is expected to be under a bit of a pressure today. They have undertaken sale of the stressed loan portfolio with an outstanding value of 304 odd crores to an ARC. Now, this is for a consideration amounting to 16.74 crores on security receipts consideration basis. Now, the ARC has subscribed to 91.5% of its security receipts, which would amount to 15.32 crores, while Spandana has subscribed to 8.5% of security receipts amounting to nearly 1.42 crores. This deal will definitely help the company clear its book, but on the other hand, they're getting in very little as far as the overall asset value is concerned. That is the reason why I'm going with the red for Spandana Spurti. And lastly, let's watch out for Pondy Oxides. They are looking to raise up to 250 crore via QIP in one or more tranches, and they've also determined October 16th as a record day for a stock split of 1:2. So going with the green for Pondy Oxides.
All right, got it. Thanks so much for all of those names. Vivek is watching out for some more stocks, including, I think, Reliance Power. So much news flow, Vivek, right, on Reliance Infra Power on a daily basis suddenly. Tell us what's the latest.
Well, that's right. All three of the companies, have reduced debt significantly and also announced significant fundraising plans. So Reliance Power has joined, the fundraising bandwagon. What's actually happening is a preferential issue. Companies raising a little over 1,500 crore rupees at 33 rupees a share, and they're issuing close to 42.6 crore shares. Who are the investors? Reliance Infrastructure, Autumn Investment, as well as Sanatan Financial Advisory Services. The preferential issue will enhance the net, worth of the company, and there will be zero bank debt as far as Reliance Power is concerned. What is it that they're raising funds for? For utilization and expansion of business operations. They also want to enter renewable energy and debt reduction as well. Now, talking about GR Infra, the company has emerged as the lowest bidder in a tender invited by the Maharashtra Metro Rail Corporation. Bid value of a little over 900 crores, and the EPC construction mode is what this particular bid will be done for. Total construction period of close to 30 months.
Okay, all right. Thanks a lot for that, Vivek. Well, let's hop across to Vinny. She's here to tell us about some more stocks and news. Morning, Vinny.
Good morning. So I'm keeping 3 stocks on the radar. We'll start with AstraZeneca. A positive move is what we're expecting. Now, the company has received the approval from the Central Drug Regulator. That's the Central Drug Standard Control Organization, and this is for a cancer drug. So very important one, especially the launch will be happening in India. So keeping an eye on that one. We also have Thangamalai Jewelry that is in focus. Now, the board is going to be meeting on 26th of September. They are going to be considering some fundraising plan, and this could be via some equity shares or bonds or something like a QIP that we're watching out for. So important for Thangamalai Jewelry. Lastly, we have Senco Gold that's also in focus on the back of a block deal. We're expecting a bit of a positive move because ICICI Prudential has actually bought 4.9 lakh shares in the company. Now, the seller of this is Oman India Joint Investment Fund. They have sold around 5 lakh shares, around 5.9 lakh shares. That's reducing their stake from 2% approximately to 1.27%. Slight bit of a reduction there, but surely had got the demand coming in from ICICI Pru, so positive expected for Senco Gold.
All right, got that. Thank you very much, Vinny, for that. So let's quickly recap all the stocks in the news today. The ones that have positive news flow around them are Bharti Airtel, First Source Solutions, Pond Dioxides, Reliance Power, GR Infra, AstraZeneca Pharma, Thangamal Jewelry, and Senco Gold. The ones that have some negative news flow around them are PNB and Spandana Spurti. So that's our top 10 list for the morning. Let's move on now to commodities. We have Manisha joining in with all the action. Manisha, good morning. So, with the kind of headlines we're getting from Lebanon, you would expect a sort of a major risk premium on commodities. But I don't know, I guess oil isn't reacting that much, at least as of now, right?
Well, yeah, it isn't. But, we've seen 4% of gains in crude oil prices in the previous week. And after all that volatile move that we have seen, the crude is holding around those levels of $75 a barrel right now. The conflict between Israel and Hezbollah is something that the markets are keeping an eye on. But remember, all said and done, and with all of this conflict and violence, not one barrel of crude production has been impacted yet. And that is what the markets clearly are reading very closely with. In the meanwhile, we also are looking at a second major hurricane in 2 weeks forming in Gulf of Mexico. Now, that is something that could keep the prices on the higher side. And then again, the speculative net long positions have improved at lower levels. So there is some entry that the money managers have made at crude oil prices around $70 or so. And we've seen 28,000 lots being bought yet again in the previous week. So these are some numbers still in the developing stage. But the escalation in violence and the geopolitical tensions have been supportive of gold, holding at around $26-30 an ounce, which is an all-time high for those prices. Silver continues to gain as well. And in the base metal prices also, there are speculative long activities being improved. So whether it's copper, aluminum, zinc, we have seen new net longs being added into this one. Most of the base metal prices also in the Asian market seem to be trading in positive right now.
All right, Manisha, thank you very much for that. So commodities very much in the focus with some announcements coming in from China this morning as well. We'll take a break. We're back. Amnish Agarwal, Head of Research at Prabhudas Lilladher, will be joining in with some specific stock discussion. Stay tuned.
Welcome back. Hope you're having a good morning. Amnish Agarwal, Head of Research at Prabhudas Lilladher, joins us on the show. Hi, Amnish. Thanks a lot for joining in. Amnish, wanted to ask you your view on metals. We're having soundbites coming out of China that indicates that they're trying to make a bit of an effort out there to pull their economy out of the doldrums. What's your view on metals? Normally you'll see a positive rub-off, but what's the pick of the pack?
Okay. You see, in terms of metals, as you rightly said, a lot depends on China because the kind of consumption and the production which is there in China is multiple times than what we have in India. And if there are serious attempts to bring the China out of, you can say, out of a slowdown, plus the kind of interest rate cuts which we are now witnessing in Europe and US, and if there is some revival in demand, then the metal prices can actually improve from here. And Indian metal stocks usually react positively to the increase in the metal prices globally. So at the current juncture, the two stocks in metal which we are liking, Hindelco, look more as a structural pick because of Novelis and because the way the company is positioned. Otherwise, in the ferrous space, we have been liking two stocks in particular. One is Jindal Stainless and another is JSPL. But incrementally, I think it will not depend upon how the international moves come. And if the international prices remain firm and the demand revives, then we could see more up move coming in some of the metal stocks.
No, I mean, absolutely. The thing is with this China stimulus, etc., is that they've said so much over the last couple of months that they've announced some things here, there. So you got to really sort of look at what really happens. I mean, it's not like a given thing. It's not a surprise. I mean, this was expected, and a lot has been done before as well. So the market is a bit more skeptical at this point. Just a few names, Amnish, I want to throw your way. These are big movers, right? Amber was a big one. Which went up. SBFC, I don't see any very much brokerage coverage, which is small business finance. Fairly recent listing, went up 20%. And maybe VIP Industries, if you have any thoughts. Amber, SBFC and VIP.
You see, VIP Industries has been under pressure. If you look at, say, last couple of years, the inventory has been piling. They have even lost some market share. But in the past few months, the company has been in the process of clearing the inventory. Now, I think the raw material prices are favorable, and the second half is likely to see some sort of a revival in demand overall for the industry, because 1Q in particular, and I think even up to maybe July, August, the demand has not been that great. So like what is happening in the entire consumption space, the entire hopes are hinging on, you can say, what happens in the upcoming marriage and festival season. And with a lot of the, you can say, the old inventory getting out of the way in VIP, I think things could be, you can say, things could start improving from here. And this is one stock in the consumption space, again, which has come up significantly from 700 rupees plus, and the kind of frenzy we are witnessing in your consumption stocks. I think VIP could also be, you can say, one such stock where the market believes that the performance might have bottomed out, the things might start looking up with the revival in the festival season.
But VIP versus Safari, what's the choice between the two at these valuations, at these levels?
I've been preferring Safari over VIP because the visibility of growth here has been strong. In Safari, I think they are expanding the capacity significantly and they have been gaining market share. So on a relative basis, we prefer Safari over VIP.
Got it. All right. Let's talk about a couple of these PSU banks. Then, you have PNBA that's announced that QIP of around 2,500 crores. And there was a big, a lot of enthusiasm with regard to PSUs on the whole, and banks as well did participate. In the last, 10 days or so, we've seen that the private sector banks actually have outperformed. Your pick from the banking space?
You see, PSU banks have been leading the pack. If you look at, say, last 12 to 15 months, PSUs have done particularly well. The price to book of most of the PSU banks, say 1 year and a half back, it was 0.5, 0.6, and subsequent to the re-rating, which is, it was not in the air. You see, your books are improving, your NPAs are coming down, and the growth rates have been better. But now, if you look at on a relative basis, private banks, their price to book today is significantly lower than where they used to trade pre-COVID. So that is why the private banks actually give you a good trade at the current juncture. And in case of, say, private banks, particularly, you see, barring ICICI Bank, you look at HDFC, you look at Kotak, you look at, say, all other IndusInd, Axis. So all of them are trading at a discount to their pre-COVID levels. So with your NPAs under control, growth rates improving, I think the private banks actually can provide very steady returns even from the current levels.
Absolutely. I got that. Just a few other names here, Amnish. The auto names, right? I mean, Friday was a big day for names like M&M, Escorts. Yesterday, again, autos are doing well. M&M was the top gainer on the Nifty. Bajaj Auto sort of piled in. There was Hero, which did very well. This is just sort of rural recovery. I mean, that's the play which is working its way through.
Shant, it does seem so, because all these three stocks, they're a big play on the rural recovery, and with the monsoons being normal, a lot of hopes are there on the rural side. And you see, these two stocks, M&M and Escorts, they have got tractor, but at the same time, M&M is perhaps the only player. If you look at the entire PV space, they are still growing in double digits relative to others which have been flattish or they have shown declining volumes. And with the Thar new launch which is coming, I think a lot of, you can say, the build-up and hopes are around that. And if their volumes in your PVs, they continue to be showing the growth the way are, I think M&M would have more legs, more upsides in the, you can say, coming months and quarters. Now coming to Hero, I think a classic, your rural play. And with the revival in rural demand, I think Hero should do well. In the past, say 6 to 7 months, the stock has done well. And I think from here on also it can outperform at least for the next 3 to 6 months.
Okay, all right, Amnish, we'll leave it there. A quick conversation, shorter conversation there, but appreciate you coming on here, as always, with us in CNBC. What we want to do is play out sort of the big CNBC TV18 exclusive. This is veteran banker and JP Morgan Chase's global CEO, Jamie Dimon, saying that India is doing a lot of things right. It's shown a lot of optimism about growth prospects. I spoke with him yesterday, and he said there is a lot of room for interest rates in the US to go down. We spoke about geopolitics, which he thinks is the #1 determinant for projections about how the global economy is going to do. And there he's skeptical. He thinks geopolitics is getting worse, and one needs to be prepared to deal with what may be coming our way. Listen in to some of that conversation from yesterday.
Well, look, going to China, okay, national security, America was overly reliant. That's not being angry at them. You should ask why we didn't do it before. But in terms of rare earths, semiconductors, penicillin, ingredients for pharmaceuticals, obviously every nation look at it and say we can't rely on someone who might one day be an adversary. That doesn't make them an adversary today. For supply, just like JP Morgan's always have multiple diverse supply chains, we don't rely on anything. The second one is around disagreements around policy, like if countries are aiding and abetting industries to dominate a global industry and beggar thy neighbor, well, that's not going to work either. So you're going to have people, they're going to be hard fought. It's not going to cause deglobalization, but it's important that countries do that. And so, and it's just starting. It would take years. There's semiconductor, you're talking about 5, 10, 15 years. So even if it's going to take place, it's going to take a long time. But companies are doing it on things like iPhone. I know iPhone production. So some things can move quick. Some will take years. Huge opportunity for China. I mean, for India. A huge opportunity for India. People call it the China +1 strategy now, that companies that relied solely on China are going to look at India, Vietnam, Malaysia, Indonesia, etc.
We've got U.S. elections, and I think one thing which both Democrats and Republicans agree on is China. You'd agree with that. I mean, in that sense, what's happening is in a way irreversible. The break in relations, sort of a Cold War.
I think you have to be very specific in this one. I think national security, everyone's going to do. Unfair trade, everyone's going to do. I think because of the Ukraine, the terrorism in Israel, Russia, Iran aiding and abetting, China's kind of on the other side of America in that one. So that's causing a lot of the tension. I think the better thing to do is get fully engaged, which they've done, our government, to try to protect ourselves in national security, unfair trade. And yeah, I think if the war goes on, yeah, there will be contentious issues between far more contentious because of that. So both sides, I think, will be fully engaged. Both sides are going to be tough, but I don't think either side is talking about disconnecting.
Let's talk about the big event from last week, which is interest rates coming down, the Fed cutting by 50 basis points. Do you think it was a bit excessive, given the fact that GDP is expected to grow at 3%, the stock markets are at all-time highs? I mean, there's no issue with credit spreads, etc. Indicators are all pretty good, and you get a 50 basis point cut. What do you make of it?
I think it's a lot more ink than it deserves. I think they raised rates to 5 very quickly. They were a little late, which they acknowledged. They raised it to 5. The economy is slowing down, inflation is coming down, and relative to inflation, even if inflation is 3%, the 5 is maybe a little bit too high. So they made a big step to get it close to what they think it might be. They've got plenty of room to go down, and hopefully we'll continue to exhibit growth with inflation coming down. I'm a little more skeptical than other people about that, but it is happening, and they're just reflecting reality.
You've been cautious in the past about prospects and said, well, one has to be prepared for things going wrong. Are you a little more positive now? I mean, this is not a cut when you're facing a recession or things are looking weak. It's like a happy cut. So, I mean, are you a little more...
So my caution is all geopolitics, which may determine the state of the economy. But it's really the geopolitics that these things, they're getting worse, they're not getting better. There's chance for accidents in energy supply, God knows other countries getting involved. You have a lot of war taking place right now. You have American warships being attacked almost every day in the Red Seas. That's my biggest question. The economy fluctuates. I don't worry that much about the fluctuation of the economy, and obviously the Federal Reserve will try to do its job to moderate the vicissitudes of the economy. But we are spending a lot of money, and in my view, that spending the money causes growth. It also causes inflation. And whether it all moderates, I think it's true for countries around the world. We got to really think through how much debt countries can put on before it causes a real problem. So I'm long-term optimist. Short run, I'm a little more skeptical than other people that everything's going to be great. Markets are pricing things like they're going to be great. I'm putting me on the cautious side of that one.
Right. I mean, rising interest rates did not hurt markets. Will falling interest rates be an impetus? I mean, can they be a further impetus?
Yeah. Again, so when you talk about rising, things are, sometimes history rhymes, but it's not always the same. I think when rates went from 0 to 2.5, that was barely rising rates. That's just kind of normalization. And we had very strong growth coming out of COVID, so 5% was probably needed to slow things down just a little bit. Yeah, underneath the rate, there's a real economy. No one knows what that real economy is going to do next year. No one. And so I don't look at it like, they're panicking to, maybe the economies get stronger, maybe it's going to get weaker. And so they're trying to remember they're reacting to data they see today. And then you can try to predict what the data is going to be a year from now. I think there's more underlying inflation because of things like the green economy, fiscal spending, remilitarization of the world, demographics. Those things will drive inflation down the road. And even AI, in my view, right now it's a little inflationary because we're all adding a lot of talent around data. It's not the deflationary part may happen, but that may be several years down the road. Yeah.
Right. You are, when you say you are a bit more skeptical, is that the economy you're skeptical about, or markets and what they're pricing in?
Both.
Both.
I think the stock markets and the bond markets are pricing in a soft landing. Okay. But you also look at the stock markets are generally very high, and bond spreads are very low. And that's kind of Goldilocks, and that may very well happen. I mean, I'm hoping for that. I just give it a lower odds than the market does.
Of that happening.
Yeah.
Well, interesting conversation between Prashant and Jamie, and we'll keep getting you snippets all through the day. So stay tuned to that. For the time being, though, we'll slip into a short break. You come back, we'll get our technical experts, Mitesh and Sudarshan, are waiting for us on the other side.
Okay, all right. We have the market open in about, 11 minutes or so from now. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do as far as trades are concerned. Gentlemen, great to have both of you here. Mitesh, very, very close to 26,000. Will that be a psychological resistance even for a bit, or you think market cruises past that?
Prashant, typically, I think, I would say that, yes, there should be some supply around this 26,000 level. Though we have extended targets of around 26,400 to about 26,500, but typically the round number does, typically warrant some kind of profit booking. So the way we'll do it is that post the gap up, I think till the gap is filled. So let's say you'll have about 70, 80 point kind of a trailing stop loss. So post the gap up, just use yesterday's high as your trailing stop loss, maybe 5 points below that, and hold on to your long positions.
Got it. Okay, hold on to your long positions. Got that. Sudarshan, what's your call on the index?
Yeah, good morning. Well, the market is in a strong uptrend. We want to stay long and try to buy on every dip. Now, there's another point. We had a very big rally on Friday, Thursday, Friday combined, let's say. Now, that rally requires a lot of consolidation. So we are likely to consolidate in the next few days, 2, 3 days, 4 days. I mean, no one can predict how many days. But within that consolidation, every dip remains a buying opportunity because the assumption is once this consolidation finishes, we'll again break on the upside. So stay long and look for dips to buy. Keep a 100-point stop loss.
Got it. All right. Stay long on the index. Look to buy the dips. That's a clear message coming in from Sudarshan as well. Sudarshan, why don't you go ahead first and tell us what are the stock picks you have for the day?
Sure. I have a long list of my mid caps. CanBank is a buying opportunity with a stop under 101. Balrampur Chini is a buy with a stop under 556. Power Grid is another buying opportunity, stop under 328. And SBI Life, the last and fourth buy with a stop under 1823. The common theme for all these four stocks is that they are going through minor dips. So essentially, we are looking to buy on a minor dip, which is a good location to buy.
Okay, all right, now got that. Mitesh, what about you?
I have a buy on L&T Finance with a stop at 180 for targets of 192. HDFC Life is a buy as well. Keep a stop at 714 for targets of 755. Sale or Steel Authority, I would want to buy on a mild decline. It's around 128, 128 half. Buy here with a stop below 124 half for targets of 136. And final buy call is JK Cement. It rallied well yesterday, but just trading at the supply pivot. So around 4,800. So wait for the stock to get past 48, 10, 15 and then buy. Keep a stop at 47, 45 and 49.60, 49.80 should be the target area.
Right, no, got that. By the way, yeah, you're absolutely right. I mean, that insurers which all got sold into, they've been recovering last 2 days actually. And yesterday was both HDFC Life and SBI Life both did well, were some of the big gainers of the Nifty. The auto names, Mitesh, I don't know, Bajaj and Hero, these are Mahindra and Mahindra is the other one. 2 or 3 days now, I mean, they're seeing some action. Technically, how they're placed?
So we've had buys on, sorry, not Bajaj. We had buys on Hero Motors and Mahindra. I think they both look good and there should be more trading upside from these levels for these stocks. The only thing is that Bajaj I would want to avoid purely because of the rally which has already happened. So if you enter now, your risk reward question is very skewed. But Hero Motors on a mild decline, I would still be a buyer.
Okay, all right. Thanks a lot for that, gentlemen. We'll come back to you all for your 9:10 call. For the time being, we'll slip into a short break. We come back, we'll get you the pre-opening rates. We'll also have with us Dayanand Mittal of JM Financial to focus on the oil and gas sector. Stay with us. Welcome back. Hope you're having a good morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, let's get in Avni Bhatt then, who joins us to help us out with some F&O strategies. Hi, Avni. Good morning and good to see you in as always. First up, are there any cautious signs with regard to some of those data points that are looking a little bit stretched? If you could give us a couple of observations there.
Good morning, Nigel, and a very good morning to all the viewers as well. So there is no red flag as such currently. The only thing is that the pace of up move may probably slow down because yesterday we had seen an uptick in India VIX of almost around 7.5% without any major short covering rally and in spite of a positive price action. So this indicates that the pace of the up move may slow down from here, but there are no red flags as yet. Second pointer is the FII long short ratio. It is at 75% longs. Once it reaches around 83 to 85%, that would be a good time to ring the caution bell and book out some profits from those levels. Till then, I think one should enjoy the FII participation and the contribution to the up move.
So tell us your strategy then on the Nifty. It's the GIFT 50 suggesting we start out gap up with a gain of around 50 points. Would you chase the opening? Would you be looking to buy on dips? And if you could give us levels on the down and the upside.
Yes, so there's a clear trading strategy for Nifty. This being the monthly expiry, there's a huge open interest built up at 26,000 call. So in case if Nifty manages to cross 26,000 and sustain for at least 15 minutes during the day, I think we'll see a very good sharp, a rally, short covering rally on the upside that may take Nifty up to around 26,200 in no time. So a clear-cut trading idea is buy about 26,000, keeping a stop loss of 25,800 on the downside. And upsides could extend up to 26,200 to 26,300 levels. That would be the trading strategy on Nifty. Similar trigger levels for Fin Nifty is also around 25,000 mark. So that's the trading strategy on the index.
Yeah, let's wind this down with stocks then.
So some of the stocks, I have 3 stocks on radar. All 3 are reversal plays, as chasing breakouts can be dangerous at the current juncture. The first is Coal India. It has seen a good recovery post Friday's up move. Yesterday, we had seen some follow-up buying also, with 12% long addition in futures and 11% uptick in volumes. So it's a good candidate for reversal. One can buy in the region of 495 to 500 for a target of 535 and 540, keeping a stop loss of 485. The second space is the insurance space. We had recommended SBI Life Insurance on Friday, and it is almost hitting our targets. Another stock on the reversal point is HDFC Life from the space. One can target around 760 to 775 levels on the upside, keeping a stop loss of 702. And the third stock is from the banking space, which is IDFC First Bank. A very long consolidation seen, and a good support base has been formed at 70 to 71 area. So one can buy the stock for a target of 77.5 and 80 for the October series, keeping a stop loss of 71.75.
Okay, all right. We'll leave it there. Avni, thank you very much for joining us, and good speaking with you here on CNBC this morning. I mean, the first rates in the pre-open are also coming through. We've got the Nifty, which is down about, obviously not 200, but it's just the first sort of rates all over the place. Should settle down in a bit from now, and we will have more settled rates in a couple of minutes or so from now. Amnish is still with us. Amnish, thanks very much for waiting. I just wanted your thoughts on, I don't know if you've, a couple of stories on Reliance Infra, and I mean the comeback in that sense of the ADAG stocks. Fundraising happening in Reliance Infra, 2 prominent investors putting in money, the debt level, debt being cleaned out, looking at newer opportunities on EVs, etc. I don't know if you've looked at this, and how would you read it? Casually, people kind of, make all kinds of comments. Well, things like, that group starts to raise money. What does it mean for the market? But I think that may be a little unfair if you've not looked at what they're trying to do very specifically. I just wanted your thoughts.
Yeah, Prashant, I am not on top of what is happening in that company, so for me, not fair to make any comments.
Okay, that's a safe one. Got that. Amnish, what else are you watching out for? What's catching your interest?
You see, the main thing which is happening is, which I believe that a lot of hopes are getting built in on the festival season, rural, and what happens in the coming wedding season. So, like we used to say in case of, say, infra and many of these stocks, that every year we see that second half is going to be the driver. And it took many years for the recovery actually to set in. Now, the kind of valuations many of the sectors are trading at, and the kind of optimism which is built in. So next 3 months are crucial from the demand viewpoint, whether it is rural, urban, or you can say broader demand. If we see any sort of a weakness in the demand in comparison to what people are anticipating, then I think that we might be overestimating the kind of, you can say, uptide in terms of, say, the overall growth.
Okay, all right. Thanks a lot, Amnish, for joining in and helping us out with some fundamental analysis. Wishing you and your team a good day ahead. Well, let's turn our attention to the oil and gas space. Dayanand Mittal, the oil and gas analyst at JM Financial Institutional, joins us on the show. Hi, Dayanand. Good morning and good to see you. And thanks a lot for joining on the show. We've seen a bit of a bounce in oil prices, according to the sheet that you all put together. What kind of range are you working with? First on Brent crude prices.
Yeah, thanks, Nigel. Good morning. So our view has been that the recent correction in oil price was more on account of exaggeration of the weakness in Chinese demand. So Chinese demand has been soft, but nowhere it has collapsed. So instead of global oil demand growing at about 1 million barrel per day, or about 1%, it has been cut by about 10 to 20 basis points, but still oil demand growth is robust at about 0.8% or so, which in no way is a shocker. So the recent collapse in our view was more due to a lot of speculative activity which takes place in commodities, and hence it was an exaggeration of that. Our view on crude price is based on the presumption that OPEC Plus still continues to have a very strong pricing power, primarily because OPEC Plus during COVID times had cut output by 10 million barrels per day. As of now, they've cut output by still about 5.5 million barrels per day. So they have enough headroom to cut further in case there's a demand shock. And second, US crude production has not been rising despite the very high oil price we have seen over the last few years. This is because of a lot of ESG concerns, unavailability of equipments, and more importantly, US oil companies becoming more sanguine and focusing on ROC rather than just simply on growth. And hence, OPEC Plus, we believe, will continue to have a very strong pricing power, and they will try using that to ensure crude stays around that $80 per barrel level, which is a fiscal break-even for Saudi. So views continues to be around that level. Brent will stay around that $80 per barrel. It will not spike beyond 85, 90, given the lot of demand concern, and fairly so. So yeah, around $80 is what we think it will stabilize at.
Okay, interesting. Dayanand, thanks for neatly putting that together. Then how do you approach stocks? If you believe that Brent is going to be holding at around $80 per barrel, will you look to buy into ONGC and Oil India, which weakened a little bit in the last month or so, but from the recent close, they've bounced well as well?
Yeah, that's exactly our view. So we have put out a note last week highlighting that same thought, that we continue to prefer the upstream company, particularly Oil India, given the very strong production growth outlook over the next 2-3 years, about 30-40%. And also ONGC, given about 12 to 15% cumulative production growth outlook over the next 2-3 years. As we all know, because of windfall tax, their realization is capped at 75. So anything above 75 gives market that comfort that 75 net realization is here to stay. So and valuations also, though all the PSUs have rallied, but here in upstream companies' case, both ONGC and Oil India valuation are still in a reasonable zone. And hence we prefer ONGC Oil India over the OMCs, where we believe probably valuations are a bit stretched, and also refining margin, we are not as bullish about refining margin as many in the streets are. And marketing margin, the current high marketing margin, we believe is not a sustainable one. It might stay for a couple of months, a couple of quarters, but yeah, it's not sustainable. So one should not bake that in future estimates.
Got it. All right. What about how do you approach the OMCs? The fear is that we have a couple of big state elections coming about. Crude oil prices have been a little bit weak as well. And that's what could weigh on these counters. Your take?
Yeah, so as highlighted, so we believe the current high marketing margin which they're making, which is 6, 7, 8 rupees above the historical margin that they earn, that is not sustainable. It's just a matter of few months, quarter here and there, when government either cuts fuel prices or in our view, most likely they will hike excise duty. They would not like to preempt crude price and take a fuel price cut, given we all know crude is highly volatile, geopolitical tensions are pretty elevated, so crude can bounce back any moment. So reversing fuel price cuts in India might be a challenge. So safer move for the government might be to go for an excise duty cut and some marginal fuel price cut. Yes, elections are around the corner, but as you know, it's just in a couple of states. So doing a pan-India cut may not be the most likely move, or if any, it might be a limited couple of rupees only, I guess.
So preference is more for the producers rather than these oil marketing companies, it seems. Anything else you like with regard to the oil and gas space? Any big calls, buy or sell recommendations from the space, besides the names we've already discussed?
Yeah, so in the gas names, we like Gujarat Gas among the CGD space, particularly because we believe spot LNG prices in the medium to long term are likely to moderate from current 16-17% of crude. It might moderate to more like 10-12% because a huge LNG supply capacity addition which is happening globally, particularly in Qatar and US starting CY26. And hence moderation in spot LNG price boosts competitiveness of Gujarat Gas business model versus propane. So that stock we like. We also like GAIL, given the gas transmission business is doing relatively well after a tariff hike last year, plus India's gas consumption is likely to grow at 5-6% CAGR. The gas trading business is doing relatively quite good. So we like GAIL as well. And overall, Reliance, though, is not purely oil and gas, but yeah, we like Reliance with more due to telecom and retail business.
Okay, all right, Dayanand, we appreciate you joining in and helping us out with your analysis of the sector. Wishing you a good day ahead, and we look forward to chatting up with you in the near future. Well, let's get in Mitesh back as well as Sudarshan to help us out with the 9-10 call. Sudarshan, you go first.
SBI Life, considered buying SBI Life with a stop under 1823.
Got it. Okay. All right. And what about you, Mitesh?
Yeah, L&T Finance, buy for targets of 190.
Okay. All right. Thanks a lot for that, gentlemen, for joining in and giving us your picks out there. Well, let's focus on the metal space. China has announced a slew of measures which can be positive for the metal stocks. Now, they say that the PBOC will cut the reserve requirement ratio, which is more commonly known as the RRR for banks, by around 50 basis points. They've stopped short, though, of giving a specific timeline for this cut. They've also hinted that the RRR could be cut by another 20 to 25 basis points by the end of this year. They've also given a few more highlights, and let's run you through a few of them. They say that they'll cut rates on the existing mortgage loans. They'll cut the 7-day reverse repo rate by around 20 basis points. It's at around 1.7%. They say it'll come down to around 1.5%. And they'll also cut the minimum down payment ratio for second homes to around 15%. Earlier, I understand it was around 25%. So that's a slew of measures that they've already announced. And that big RRR cut is something that will enthuse the metal stocks on the whole. Phillip Capital, they have said that they maintain their positive stance on metals. The top picks for them are JSW Steel, JSPL, that's from the ferrous space, and from the non-ferrous space, Nalco and Vedanta. They've also recommended accumulating NMDC as in sale, but in a staggered manner. So the metal index could be in the focal point today, going by what we have seen in terms of action coming in from the Chinese regulators. But let's move on then. Let's talk about utilities. Vivek joins us to run us through a Motilal Oswal note and all the stock that he's tracking. Vivek.
Well, good morning. A very interesting note coming in. It's a thematic note that is coming from Motilal Oswal. They've written on the utility space, and what is it that they're seeing? They're seeing a colossal multi-decade investment opportunity where they see investment of close to 40 trillion rupees. Now, when you're talking about this particular investment, how is it that they're breaking it up? Firm opportunity of 34 trillion rupees in firm capex and another 8 trillion rupees as an optionality upside. Now, out of this spend mix, generation spends are expected to see 86% of the total mix, transmission close to 10%, and smart metering another 4%. What, according to Motilal, are the key tailwinds for the sector? Number one, power demand today is accelerating at a higher 7% CAGR versus a historical trend of 5% CAGR only. Also, they see a lot of spends coming in as far as upgradation and replacement of old infrastructure as far as the utility space is concerned. As the electricity mix undergoes a shift, now they're looking at more renewable energy, all-day electricity coming in. And lastly, they're seeing transition to cleaner sources of energy, given India's target of 500 gigawatt in renewable energy capacity by 2030. So what are the stocks that they like? They're initiating coverage with a buy rating on Power Grid, JSW Energy and Tata Power. They have a neutral rating on NTPC as well as IEX. Watch out for the entire space in the few coming days.
Okay. All right. Vivek, thank you very much for that. By the way, Vivek, since you're there, I mean, a lot of interest in the Reliance Infra stock, Reliance Power. I mean, anything new? What are you hearing on these names?
Well, that's right, fondly calling them as the ADAG group stocks. So what essentially happened, as far as Reliance Infra is concerned, Reliance Power is concerned, and the other group stocks is the fact that, number one, there has been quite a lot of debt reduction that has happened, and number two, there has been a significant improvement in terms of the net worth, given the fact that there has been fundraising that has been done successfully. In some cases, it's actually the promoter entity that has been infusing funds, but also there have been some noted investors that have come in. So, this particular space too and that particular group too, given the fact that the listed entities now have zero bank debt, is something that we'll keep an eye out for. What we'll also have to watch out for is the kind of promoter pledges that exist, and that is something too that we'll need to keep a close track on.
All right. All right, Vivek, thank you very much for that. That's basically the ADAG stocks which are in focus. Well, I think we've got a couple of seconds to go for market opening, and there is a lot to track in terms of individual stock-related news flow, but the broader market as well. For the index, of course, there is the question of 26,000. Let's just look at what the pre-open has left us with. 25,921, a flat kind of a start. Slightly down, but nothing at all. The sensex should also come up, the Nifty Bank, and where that is at. And we'll see whether there is, sort of continued momentum in some of the names which have done very well recently. Autos really top of the list there in that sense. So 70 points lower on the sensex, about 17 points lower on the Nifty is what we have. Okay, first trades coming up on your screen. So 25,920, 0.07% change. Nifty Bank, 54,032, 0.16% lower. We've got the sensex, which is around about 0.25%, 84,760. Mid-cap index is starting just so slightly in the green, about 0.15% higher. IT index, actually the IT services index was the top loser yesterday. One of the very few which was down 0.75%. It's down another 0.5% this morning. So 41,791. It's down another 0.5% or so as we begin the session. The heat map on the Nifty appearing on your screen now. Equal number of stocks which are higher and lower. I think more down than up actually on the Nifty. A 30-point cut to begin the session. Let's get to stocks. Nigel.
Well, that's right. Fusion Micro, that's the one that continues to be the top loser today. It's down close to 5% and falling on very large volumes. Investec has downgraded the stock to sell. Target price has been cut to around 300 rupees. CLSA as well, they have downgraded the stock to underperform from outperform, and they have halved their target price to 260 from around 550. So that one, in fact, is down close to 20% in the last two sessions. You have SBFC. Well, that one, in fact, yesterday was up close to, I think it was locked up. That one is taking a hard knock today. It's down close to around 3%. Maybe, in fact, just there's some mild profit taking after the big move that we saw yesterday. But metal stocks, they're in focus, as we mentioned earlier. The sound bites coming out of China were encouraging, and they're indicating that they want to do something to get their economy up and running. So you have Nalco that's up close to around 5%. Big move you're seeing out there. The other ferrous names as well are moving up. Tata Steel is up. Vedanta, I think, as well should come up for you on the screen. There is that niggling worry with regard to what goes on in their alumina refinery. For the time being, though, the stock has popped up and it's up close to around 2%. So good move out there. VIP, we mentioned earlier today. Then Mr. Kedia had checked in. He bought close to around 7.5 lakh shares. In the next 2 days, they have a lot of big investor meets that are lined up as well. And VIP has been a big underperformer. In the last 1 year or so, the stock is down more than 10% in a very, very buoyant market. So that stock is, well, one of the top volume winners in trade today. GMR, I think there's an initiation note coming in there. So that stock has opened up with good green, up close to around, I think, 4% or 3.5% as we speak. So in the frontline names, metal stocks are doing well. Nalco, NMDC, SAIL. You have Escorts, Kubota as well. That's up close to around 2%. So some of the top volume movers out there. And Ramco Cement is one of the top volume losers in terms of the F&O market. So that one's down close to around 1% or thereabouts. But let's get a chat going. Surbi has hopped across to the JPM conference, and she's speaking with James Sullivan. Surbi, take it away. All right, I think we'll get to Surbi in just a bit from now. But the reason that the Nifty is down is because the tech pack, you have Infosys that's down close to 100%. Wipro is down, HCL Tech. So tech is dragging actually in today's trading session. Put up the IT index. Both the pillars of the market have started off on the back foot. That's tech as well as the Nifty Bank. But the Nifty Bank has been the leader. It's been the one that's driving the index up. So we'll have to see whether or not this dip gets bought into on the Nifty. What's doing well? Metal stocks, but they don't account for very much in terms of a weightage out there. But as promised, Surbi's got James Sullivan, the head of APAC research at JP Morgan. So let's go across to that conversation. Surbi, take it away.
Well, Nigel, thank you so much for that. I'll tell you what, we were discussing some running stories around the streets of Mumbai, not so much markets, but now we'll take James's focus back to the market, which continues to make such headlines over here. James, it's such a pleasure to be here with you in person, and thank you for making time for us. And we talk at a very interesting time, right? Because we have global markets at all-time highs, and now you have the central banks increasing the music, whether it's the Fed or the PBOC overnight. Can the party continue?
Thank you very much for having me. It's great to be back here in Mumbai. Look, I think the critical element to think about from an Indian market perspective is the degree to which market performance for the past couple of years has been really a DIY story. If I look at flow of funds, It's been almost entirely domestic investors that have driven this market, and yet that still has further to go. If I look at domestic household participation in the equity market, we're only at about 5 to 6% of Indian households, which is low for most emerging markets. So again, more runway from here. If I look at foreign investors, you're still looking at foreign investors dramatically underweight this market and falling farther behind as the market continues to perform. The JP Morgan estimate is that we need to see about $100 billion US in incremental inflows into Indian markets for institutional investors to just get to neutral.
Wait, let me come in over there. $100 billion of inflows.
That's correct.
Just to get to neutral weight.
Correct.
And do you really see that kind of money coming in, and over what time? And then what happens to valuations in India?
So year to date, you've only seen about $10 billion in inflows, so an incremental $90 billion to go. And then incrementally, we need to look at sector and stock selection to understand where that's going to go. We still see a very strong earnings growth story coming out of specific sectors within the Indian economy, in particular infrastructure, construction, as we start to look at supply chain relocation, which has not yet occurred coming into this market. So again, going back to this theme of market performance and economic performance has been very DIY in nature. It's been Indian corporates driving CapEx, not FDI coming into India from offshore. As that starts to occur, you still have significant incremental economic growth and therefore earnings growth, which makes valuations significantly more palatable.
Okay, just one more question, and then my colleagues in the studio also have several questions for you. Just this morning, we've seen easing measures out of China. And we know that that's one market that a lot of foreign investors have stayed away from for obvious reasons. Tactically, do you see China getting more flows, or will they keep coming to India for the reasons that you described?
So 2 points I would make. Number one, again, you have not seen aggressive foreign buying of the Indian market yet. So it's not like that's going away. It hasn't actually occurred. And so incrementally for that to come, you'd see the Indian market go up, not down. The conversation regarding China gets interesting. What we've seen from most investors is we've seen some folks start to come in and bottom fish in certain sectors where you have very low valuations and very strong cash flows. In particular, in the internet, e-commerce space, we've seen some incremental foreign buying. It's very much, we'd like to see the data points, not the announcement, however. And so I do think you'll have to see earnings come through in a more aggressive fashion to see fund rotation back into China from here. But we are overweight certain sectors of the China equity markets off the back of very low valuations and very low expectations.
Okay, great. So we're getting the money. We've been getting a lot of the domestic money, and we're probably going to get more foreign money as well. Let me just quickly hand it to my colleagues back in the studios. They have some questions as well. Sure. Prashant, Nigel, over to you.
Surabhi, thanks very much for that. That's a big number, right? $100 billion to get up to sort of neutral weight. James, one of the things we've heard sort of repeated again and again when we speak with investors, foreign investors, etc., is that this underweight may remain because valuations remain very high and foreigners kind of feel left out. And they don't really want to chase stocks higher because that's what they have to do. I mean, it's a very different situation if they came in size a year ago or a year and a half ago. Do you think eventually, people will just throw in the towel and they'll have to just get in? Or it's possible that they stay out for a while longer? What's your sense?
No, thank you for that. I think there's two different criteria that I'd be looking at, particularly from a foreign investor perspective. Number one, earnings incrementally have to come through. First quarter was a little bit on the slow side. JP Morgan estimates is that you'll see a re-acceleration in certain sectors, but not the overall market as a whole. And so again, very clear stock and selection bias rather than just broad asset allocation into the Indian market. The other reality, if I'm looking at it from a foreign investor's perspective, however, is tracking error relative to my benchmark. The degree to which India market outperformance continues to accelerate and I'm underweight, I'm seeing more and more drag on my overall performance numbers. So you could start to see investors try and square those positions as we come into year end. It's also just very interesting from an investor psychology perspective. Most investors will close out their books at the end of this calendar year. You effectively get a new risk budget on January 1st. That does drive many investors to start to more aggressively change their asset allocation across countries and sectors off the back of that fresh risk budget.
James, just, you do mention the state elections which are lined up, right? So apart from valuations, do you think politics is a determinant for how investors will view the Indian market in terms of policy direction, etc.? We've had a substantial increase in handouts, or at least talk of handouts, across elections which have happened over the last 1.5 years or so. And, once you roll these out, it's very difficult to take it back. You can only expand on it. That's essentially the experience. What is your sense? I mean, could that be a trigger? And is that a risk to watch out for?
No, it's a great question, and I would approach it from at least two, if not three different directions. Number one, from a macro geopolitical risk perspective, it's important to understand the degree of risk premia built into markets. Given valuations here in India, there are not significant risk premia built in, which is important for investors to keep in the back of their minds. There's not a lot of wiggle room in the price from a geopolitical risk perspective. Now, that said, from a policy perspective, we've seen relatively clear policy goals out of the national government here in India. We've seen very clear and effective implementation across a lot of those goals over the course of the last couple of years, which is clearly investor expectation moving forward. I would highlight that the recent election here in India, as you say, has resulted in slightly more income redistributive policies coming out of the central government. At the end of the day, given the nature of Indian economic development, and Sajid Chinoy, who's our chief Indian economist, talks about this quite a lot, there's been this concept of this K-shaped economic recovery. Dealing with the bottom leg of that K is absolutely critical for economic growth, particularly on the consumption side in India. And so the fact that we are seeing government policies more proactively address that bottom leg of the K, that's actually very important for economic growth as well as political stability here in India.
Okay. All right, James, just some more questions before we let you go. So now that it's been established that there is more money coming in India and maybe foreigners are going to play catch up sooner rather than later, I think the question that people are grappling with is what to buy in India. We've had this phenomenal PSU move, state-run companies, their move play out. Those stocks are off their peaks. But do you think that's where people will go back and gravitate in? Is it still going to be manufacturing or capex? Or will there be a return to, say, consumer staples or even banks, which haven't done that well in the recent past?
I think one of the consistent refrains that we talk about at JP Morgan and we hear back from many, in particular foreign investors in Asia, is really trying to understand where government policy is going to inflect different areas of economic growth. We're seeing that very clearly in China, where investors are trying to follow government pronouncements and follow different favored sectors in the Chinese economy. Here in India, we see significant incremental government capex in infrastructure in particular. Again, that's been almost entirely Indian government as well as Indian corporate-led. We have yet to see that influx of FDI into supply chain relocation, which we do incrementally expect as well. So industrials, infrastructure are our favorite sectors. We would also highlight from a regional perspective, we talked about geopolitical risk earlier in the conversation. We are seeing very strong performance out of defense stocks in almost all countries in Asia, Japan, Korea, here in India, where you've seen very, very strong performance from some of the names from a bottom-up perspective. And as the Indian government continues to seek to diversify its suppliers in that space, we would expect to see continued sector performance.
All right, so still optimistic on some of those themes that have done really well in the last year and a half over here. Final question, James, what would be the biggest risk for this market, for India?
I think if we start to see significant policy questions moving forward, the critical element of India really over the course of the past two administrations has been policy clarity and very effective implementation of policy. If you look at Aadhaar, if you look at direct payments to citizens, if you look at a lot of the different macroeconomic policies that this current administration has pushed forward, that's been a clear driver of not only economic performance, but also drag on market performance. As we start to look forward, any shift in terms of policy certainty, any shift in terms of an investor's ability to understand what are the goals of the Indian central government introduces risk in forecasting. Risk has a price.
Okay, all right. So as long as policy continues to move at the pace that it has, and if there's stability and continuity, we're getting $100 billion in inflows, in all probability, right? That's the big headline. Thank you so much for joining us today. Pleasure having you right here with us, and this conversation, very, very helpful. Thank you very much.
Thank you.
All right, folks, back to you guys in the studio.
Thanks a lot for that, Surabhi. Interesting conversation, as always, with James. But let's get back to Corporate Corner then. JK Cement, that's the first management on the show. The stock is up close to 25% in this year. In fact, Motilal Oswal, they reiterated their buy rating. They've raised their EPS and EBITDA estimates for the next two fiscals. Unchanged for FY25, but for FY26 and FY27, they have upgraded their estimates a little bit higher. Mr. Anuj Khandelwal, the business head at JK Cement, joins us on the show. Hi, Anuj. Good morning, and thanks a lot for joining in. Well, let's talk about demand first up. You know, the first quarter was marred because we had elections. There was a heat wave as well. And the monsoon season as well, normally impacts demand. But how do you see demand shaping up? There is talk of some production cuts, of demand being weaker than expected. So give us your estimate with regard to demand. How do you see things shaping up? And what does it mean in terms of volume growth for your company, JK Cement?
Good, Nigel. Firstly, many thanks for having me on this segment. You've rightly said, look, the last 6 months, it's been quite a flattish growth for the industry, but it was more or less anticipated given that we were coming off a very high base year. Last year was the pre-electoral demand, year for cement, if I might say so, where, in the first 6 months, the demand had grown by around 15% over the previous year. So this year was expected to be muted in terms of growth in the first 6 months, first due to elections and then intense monsoon, higher than normal. In the next 6 months or so, we are far more positive about how the demand will play out. Maybe we'll have let's say in the next 6 months, around 6 to 8% kind of a growth in demand versus H2 of last year. So in the whole year, it'll be around, let's say, 3 to 4% kind of a demand growth for industry. We as JK will try to beat the industry growth by a few percentage points.
All right. So the industry grows by 3 to 4%. What kind of a volume growth should we be looking at for JK Cement? I think in the past you were hinting at high single digits for FY25. Is that still on?
Yes, that is absolutely on. So if the industry grows by overall for the full year by 3 to 4%, given that we are in a way pegging the next 6 months to grow at, let's say, 6 to 8%. So hence, if the full year industry grows by 3 to 4%, we'll try to grow by, let's say, 7 to 8%.
7 to 8%.
And if the industry grows more, then of course our growth rates also will be higher. But tough to say. We really hope, as your guests in the previous segment said, that $100 billion might come to India. If some of it also makes way to infrastructure segment, of course we'll be talking of bigger numbers.
All right, let's talk about pricing then. Demand, you're sounding optimistic about a recovery and you'll outpace what the industry will do. What about pricing? Anuj, in the last 2 to 3 weeks, I've been flooded with information. Price hikes being taken, price hikes being rolled back, part of it getting absorbed, part of it getting rolled back. What's the current situation on pricing? Because pricing is at multi-month lows. In fact, I could say multi-year lows as well. When do you push through your first price increase? Start of October?
It's a difficult question, Nigel. Look, we need to understand how these 6 months have gone by. First an election and then an intense monsoon. So you are right, the prices are quite tepid to say the least. Difficult to forecast prices because it's dependent on many factors. But one thing, which will be a positive for the industry per se is that as H2 starts and the demand grows, the overall environment for the industry will be better. But pricing is something it's very difficult to forecast, and I better not hazard any guess on that.
Okay, let's try to focus on what you can do to make things better. I think trade is around 65% of your mix. And out of that, I think you have low teens contribution of the premium segment, which gives you better profitability, better pricing as well. So tell us, where is that number currently and where is it headed? Premium products as a percentage of trade sales.
Yes. So last year we were around, let's say, 12 to 13%. This year we want to end, or the exit run rate to be at around 16 to 17%. And in the next year, try to take it to 18 to 20%. This is a segment where we focus a lot, not just because of profitability, but essentially the segment of individual home builders are growing more and more quality conscious as they are getting more aware. So the premium products which offers better quality to them and better features to them are something they are preferring a lot. So we have it's a priority initiative for us. This year we want to exit at around, let's say, 16-17%, and maybe next year touch 18 to 20%.
Got it. All right. So we've got pricing volumes out of the way. Let's talk about capacity. The last time we chatted, we knew that you all had a goal of 30 million tons in mind. Now you've upped that. You all are looking at 50 million tons. That's nearly doubling capacity in the next few years. And I understand that as a percentage of your market share, it should be roughly around 10-11% or thereabouts. So tell us, this entire capacity addition that you're talking about, by when does it take place? What is the capex that you're looking at?
Great. So look, 1.5 years back, somewhere around November 2022 or so, we were at 16 million. Right now, we are at 24 million with 6 more million tons under construction, which will get commissioned by end of next calendar year. So let's say December 25 or so. That'll take us to 30 million, which would be like a doubling of capacity in 3 years' time. Beyond the 30 million, which is already announced expansion underway, what we are working on, which is yet to be firmed up and we are yet to take it to the board, is around, let's say, 6 to 7 odd million, which is pivoting around the Jaisalmer mines, which we have. Then around 5 to 6 million around our south plant, because that plant is sold out and we want to expand and grow our market. And then post these two plants, when they get commissioned, then we'll of course turn back again to central India to see if we can put up one more line there. We have also acquired the Toshali cements in the recent past, 6 to 7 months back. And we'll also try to see if we can work around an expansion around that unit. So while what I would say is that the 30 million ton, the plan is firmed up, it's under execution. The good thing for us is that we have plan laid out for 50 million tons, but we'll take it in a very systematic manner so that while we deliver the growth which the investors expect out of us, we also keep our financial prudence in place.
What about inorganic growth? That's where all the buzz is, right? All the excitement over there. You're not interested in inorganic. You're going to do this organically.
This you can't say because, we acquired Toshali Cements 6 months back.
That's too small. Anuj, that's too small. Toshali is very small, less than 500,000 tons. I mean, we're talking about bigger acquisitions. It could get you to that goal even faster. What's your take?
So on a serious note, look, our base plans are all on organic growth because we have the right limestone reserves to do the organic growth at a cheaper outlay. Inorganic growth, it always depends on opportunities, the competition, the valuation, etc. So it's very difficult to plan your capacity expansion basis that. None of the companies do. If you look at other companies also, they have a organic plan charted out. Inorganic growth is always a cherry on top. It will come when it comes, but our base plan is organic growth.
And I think as of now, you're expanding it around $60 per ton, right? Roughly?
Yeah, so look, if it's a brownfield expansion, it touches $60, $65. If it's a greenfield expansion, which might happen when we take up Jaisalmer, it'll be a bit more costlier. But yes, broadly that number is correct.
Since you're expanding at such a low capex, Motilal Oswal, they put out a note. They believe that your ROE and ROCE can move to 21% and 15% from around 16 and 11% as of now. You agree?
Though they are experts in numbers, I have not really, I can't really sign off on those numbers. But look, one thing which is there and which they are getting it right in their report is, yes, our capacity expansion happens at a lower rate. Secondly, we have a track record of evacuating that capacity fast. So if we were to maintain that track record, then the productivity of that capital comes in sooner. So that is something which we need to look out, evacuate our new capacities faster so that we can meet the targets which the report has set out for us.
Okay, all right. So that's what they are estimating, that your ROC and ROE will improve, and you pretty much indicate that you're looking at some cost saving measures as well. So run us through that. In the next 2 years, 150 to 200 rupees of cost savings by a whole host of measures, alternative fuel, you're looking at reducing the lead time as well. Do you think that's possible? And what would it mean for an EBITDA per ton? In the last few years, you've averaged between around 1,000 to around 1,100 odd. Give and take everything, highlight the cost saving that you're looking at and how much of it will flow through to an EBITDA per ton, because the pricing one still is a little bit dicey, the cement pricing as of now.
Okay, so maybe let me take your second question first. Giving an absolute EBITDA per ton target is difficult for a couple of reasons. Firstly, we are going through a silent period right now. And secondly, as you rightly said, pricing is such a big determinant of EBITDA that many times EBITDA per ton is not controllable, right? So from whatever our level is, we'll try to improve the cost, which will slow down to our bottom line by 150 rupees per ton or so. And you're right, all these initiatives are definitely practical, implementable. 50 rupee per ton will come from logistics costs, both through saving measures as well as lead distance reduction. We are amping up our green power. Last year, it was 51%. Already Q1 it was at 57%, and to meet our sustainability goals, we want to take it to 75% in the next 3 to 4 years. We are progressing well in AFR journey, and our thermal substitution rate is high. So a slew of measures will lead to that 150 rupee per ton cost saving, which will help us be more and more competitive in the industry. Beyond that, also we have our initiatives planned out, which will happen in medium term. We've won coal mine auctions in central India in February. So once, of course, it will take time for that to materialize, but whenever it does, it will lead to even more cost savings.
Okay, Anuj, final question before we let you go. We'll talk about debt and, capex and all the next time you join in. But I want to ask you about the paint space, because suddenly, there's a lot of optimism out there. Initially, when you'll announce you're going to go into paint, the street didn't like it one bit. But now they have come to terms with it, and they believe that maybe it's a business that goes parallelly with cement business. You're currently doing, I think, around 60 crores on a quarterly basis. How do you see this scaling up in terms of revenues? And by when does it break even? FY26? I know you're heading the grey cement division, but if you could throw some color on how the paint division is shaping up as well.
Yeah, so fair disclaimer, I don't lead the paints business, but yes, it's shaping up really well. Last year, we did 153 crores of net sales. This year, the target is between 250 to 300 crores, so which means it'll be doubling in a year's time. Yes, it has. We were always clear that it has massive synergies with our channel on the white cement and the putty business, and it is coming through. So right now, our focus more is on trying to grow the business, set up the business, grow the scale of the business. Like any new business, it'll make a few losses in the initial years, but as of now, the focus is on growing the top line per se. Also, just to reiterate the fact what I've told you in my previous interviews, we have a set budget which is there for the paint business from an investment and loss funding perspective, and we are tracking well against that budget. So it'll not be just growth and not looking at the bottom line at all. But yes, but still the break even will be a couple of years away, like it is there for any new business.
Okay, all right, Anuj, appreciate you joining in. As you said, you're in silent period, but post the results, we'll re-invite you. Then we can push you a little bit more on pricing, EBITDA per ton, as well as how the debt number is shaping up. Thanks a lot for joining in and filling us in with all of those details. Well, time to slip into a short break. On the other side, we'll connect with Sriram Subramaniam of InGovern Research Services. InGovern has raised a red flag over Religear's AGM delay. Stay with us.
Okay, welcome back. This is, of course, Corporate Radar. We have advisory firm InGovern, which has raised red flags over Religear AGM delay. They've called for essentially the chairperson, Dr. Rashmi Saluja, to step down from their roles, which they think will signal a commitment to accountability and a fresh start with a fresh board and leadership for Religear Enterprises. Remember, the battle at Religear, of course, has turned fierce and maybe murky as well. On one side is Dr. Rashmi Saluja and the board so far. And on the other side, of course, is the Burman family, which of Dabur, but the Burman family, which is trying to buy Religear. They already own about 25% in Religear. There is an open offer which is out there at about 235 rupees per share, but that offer has not gone ahead so far. I think pending, one last approval. There is, of course, also the bit about the AGM delay, where no explanation really has been given why the AGM has been postponed, where perhaps people are keenly waiting for a vote on an extension for Dr. Rashmi Saluja, the chairperson at Religear. We have Sriram Subramanian, founder and managing director at InGovern Research, now joining in. Thank you very much for joining us, Mrs. Subramanian. Prashant here. You put out very clearly, you say time to move on. And this is what you write. Amidst a power struggle and regulatory scrutiny, Dr. Rashmi Saluja and the named KMP's key management personnel stepping down from their roles in the company would signal a commitment to accountability and a fresh start with fresh board and leadership for Religear. So, of course, Religear itself has issued their own statement. They're saying, well, I'm sure you've seen it. They're calling it unnecessary. They're saying, well, it's a process which is going on, and this is aimed at influencing the securities market, etc., etc. So just explain this for us, because there are lots of interested investors as well who are waiting keenly for a resolution to this thing. So what are your thoughts, sir?
Yeah, so Religare has taken the ROC's approval, which is a logical process to get the AGM extended by 3 months. So this AGM has to be held before end of December now. But there is no logical reason. They have put out a reason which is not logical, because they have said that it is due to the this one in the open offer, the issues with the open offer, etc., which has no relevance to why the AGM has been postponed. Because at the end of the day, this is being contested in the Delhi High Court now. It's gone to a division bench. Okay, that is fine. That is understandable. But beyond that, is the company also assuring then that the AGM will be held before December if the AGM, if the open offer process doesn't get resolved by then? So that's a impasse. So there is no logical reason why they have pushed out the AGM. The only reason why they could have done it is Rashmi Saluja, being the only non-independent director on the board of Religare, has to come up for reappointment. And there is a fear that she will likely get voted out, because already, as you rightly said, the Burmans own 25%. They are they're already fighting her. Two is the other shareholders are also very keenly watching. They've had this mess of the last year and a half. So they are, our interactions with institutional investors tell us that they want a change there. So the board has been siding with her. The independent directors have not done their duty. They have just not acted in the interest of the company. They have issued ESOPs for which we had put out a note, where IRDA has come out with an order. Of course, that has gone to the SAT and is now being fought at the SAT. But yet, IRDA has given out a detailed order. SEBI has come out with a detailed order on the matter of, and issued a show cause notice to the independent directors on why they tried to stop the open offer. In India, the takeover or an open offer is a natural trigger, actually. There is the moment 25% is crossed, there's a natural trigger. And SEBI itself doesn't have any powers to stop the open offer. But at the end of the day, the company has cited some RBI permissions, etc., and that's the reason they've stopped the open offer.
So the AGM has to be held before December, as you said. Do you think it is inevitable that her reappointment has to come up, right?
Yeah.
Has to be an agenda item, or is it possible that it is not an agenda item?
No, I mean, for an external person, and logically everybody on the street expects that to be coming up. The company may cite some other logic or some other reasoning, like they have done with the postponement of the AGM itself, but everybody is expecting that she will come up for reappointment.
And then you say that there are enough votes, Burman plus institutional shareholders, and have you had a conversation with some of these institutional shareholders?
Yeah, there's a sense of I think there's a sense of angst amongst them, and that's where they are saying that the board and Dr. Rashmi Saluja have not done their this one properly diligence. Initially, in fact, they supported the open offer initially, and then subsequently last year they went against the open offer. So it's not clear as to why the board is not supporting the open offer at the first place. And secondly, it's not clear as to why they pushed out this AGM.
Okay, so before December now, AGM and the vote both should happen. So it looks like increasingly likely that Ms. Saluja perhaps will be voted out, right?
Yeah, we obviously have to see whether the notice comes up, the proposal comes up, as it is not yet announced. Okay. Once it's announced, we'll have to see. But the investors are definitely, there's a sense of angst around her leadership. Right?
Okay. Now this open offer itself, which is at 235 rupees, will that have to be, I mean, whenever that starts to come to, when it is launched, I mean, will the price have to be revised, or will there be interest at 235? Price is at about 280 today.
Yeah, I don't think the public shareholders will tender at that price. Of course, it's up to the Burmans to decide whether they want to increase the price. That's the minimum floor price. So if the Burmans want to buy out more public shareholders, so they will have to increase the price, because as you rightly said, it's 280 or thereof today. And so that's up to the Burmans. But at the end of the day, the process has to be completed, right? I mean, they already want 25%. The process has to go through and be completed. And that's a logical end to the Burmans coming on acquiring the shares.
Right, right. I mean, you know, from an investor perspective, when we speak, what is given out as a reason for re-rating is that this becomes a Burman-owned company, right? I mean, in terms of valuation,
so. I mean,
valuation
yeah,
multiples, etc. I'm sure you also hear that. How far is that process? Do you think? I mean, is there an end in sight to when you actually see?
We don't know. See, these regulatory processes could take time. Each regulator has their own. This one, the company board is against this entire process. So to that extent, they are putting spokes in the wheel of this entire process, right? At various forums, be it RBI, be it SEBI, be it IRDA, they have always put spokes. So from that perspective, we don't know how long the regulators also take to give these approvals and the like.
Okay, all right. But I think you made it clear that, in your opinion, a lot of the institutional shareholders are also watching this closely for a speedy resolution. If it happens or not, we don't know as of now. Mr. Subramanian, thank you very much for joining us with that opinion. And I think it's a story which we will watch very, very closely. Well, let me toss it across to Surabhi, who's at the JP Morgan conference, and she's sitting down with Saurabh Kumar, Senior Analyst, India Banking and Financials Research at JP Morgan. Surabhi, over to you.
Prashant, thank you so much for that. Yes, I'm here with Saurabh Kumar, who tracks a sector that seems to be finally stirring back to life. It's a sector that's been underperforming for a while, and the whole question is that when foreigners start coming back to this market, will they keep loving Indian banks and the Indian BFSI space? So Saurabh is here with us. Saurabh, great to be talking to you in person. Thank you so much for making the time for us. And, you know, I really want to start with that first question. So let's get the elephant out of the room. This whole debate around how banks are struggling to mobilize deposits and how that's going to take a toll on the business model itself, because everyone's rushing to put that money in the equity markets. Is the fight for deposit real? Is the struggle real? And if yes, can it really be detrimental to the profitability of banks?
Okay, so I think, you know, parking money into equity markets or property is liquidity neutral for the system. It's just money transforming from retail to maybe wholesale. So I think the main issue is that our nominal GDP is compounding at 10-odd%, so deposit growth at 12%, credit growth is higher, and that's a fundamental mismatch. And eventually, I think you will see credit growth converge towards deposit growth, unless obviously nominal GDP picks up. I think in terms of fight for deposits, what you will see is wholesale deposit rates are falling down, but retail deposit rates have largely been maintained. The real issue in the system is around CASA, because in this environment of asset reflation, nobody wants to park money at 2-3% on savings rates. And that is where you're seeing incremental deterioration in the funding profile. Having said that, if you look at the cost of funds movement across major banks, it's been, I mean, the rate of increase has largely moderated down. From here on, it is just CASA mix or whatever the rates do.
So that brings me to the other sort of theory and the premise that you put out in a recent note, right? Because when we're talking about bank margins, the immediate sort of conclusion that most people jump to is that it's contingent on rates.
Yeah.
Lower rates should mean better margins, and higher rates could perhaps increase the cost of funding, or maybe vice versa, depending on your loan mix, depending on your borrowing mix as well. But you're saying that's not the case. It's not really rates that will determine NIMs, but perhaps the CASA mix. So could you explain this further?
Yeah, so I think the thesis is essentially if rates come down, margins come down, rates go up, margins go up. If you basically see the movement of rates over last, let's say, 2 odd years with a 250 basis point rate hike, most of the cost of funds has been equal to the yield on assets increase across major banks. So over a 18 to 24 month period, it's a pass-through structure that most banks operate in India. You do get quarterly volatility in terms of margins coming down, but they do revert back. Over a period of time, what dictates the margin is the loan mix, which is the share of unsecured loans rising, if at all. And the other is essentially your CASA funding. And as that funding profile obviously worsens, your margins come down. So rates is a quarter, 2 quarter phenomena. I think what matters over a cycle and what I think matters from a valuation or stock price perspective is your eventual target NIMs or target profitability, ROAs.
Okay, so that's the theory. Now let's apply that to the current environment where CASA growth, like we discussed, is getting crimped. The Reserve Bank has obviously been sort of raising the red flag on unsecured lending, so your yield perhaps is getting more challenged. And we are in an environment where the Reserve Bank is expected to follow most other central banks and start easing at some point. So just take us through what you expect on NIMs here and whether you indeed expect the RBI to start easing by the end of the year.
So for JP Morgan, our expectation is for a rate cut cycle to start December. Cumulative 100 basis points will be what I think our economists forecast today. Broadly, that should lead to a 10 to 15 basis point degradation in NIMs across banks. That will
10 to 15 point degradation in NIMs?
15 basis points, yeah.
15 basis points
degradation in NIMs. Having said that,
over what period you'd expect? Over how many months?
So it depends on the trajectory of the rate hike, but it should happen over a 3-quarter period. So I think. But more importantly, I think what will also depend is how quickly they cut rate. Is it 25 basis points every quarter? Is it 50 basis points? So I think that will be more important. I think the main issue for banks is, yes, NIMs are coming down. For private banks, credit costs are also going up and growth is tapering down. All of this should mean that your EPS should be at some marginal risk of degradation till October of next year. And I think that is where I think risk of downgrades remains. Having said that, there is obviously flex many banks have in terms of their operating costs on their credit, which I think can essentially mean that there is some flex to operate at around target ROAs. Some of these numbers are also captured in the street estimates. So I think the key here is essentially who can grow faster. And this is where we basically are betting on banks where loan growth is actually faster than the system and who have the funding flex and the capital flex to basically deliver that.
Okay, and talking about loan growth itself, considering that, like we discussed, unsecured continues to be very tightly monitored and watched, and we've seen the risk weights go up there as well. What will drive loan growth? And there's this whole talk about the capex cycle picking up. I don't know if that can really incrementally drive it. So where will the book grow, and what kind of lenders would you then watch?
What we're seeing in the system, and Reserve Bank puts out this data, I think if you look at the growth is now being driven from mortgages. So mortgage growth has picked up. The large industry growth has actually picked up from about 3% to 9% if I recall. So yes, you're seeing the headline growth taper down from 15% to 14%, but you're seeing a shift in mix away from unsecured loans toward more secured retail, towards corporate sector, and that is what our overarching view is, that effectively you are in a cycle where what we call it capex over consumption, that capex linked plays are actually going to do better versus consumption linked plays.
Okay, Saurabh, hang on. Our colleagues in the studio also have some questions for you. Prashant, over to you.
Saurabh, hi. Hi, good morning. Good to see you there at the conference. Since we're talking about specific segments, I just wanted to ask you 3 segments. One is microfinance, right? I mean, there's a lot of talk that we're going through a down phase, a down cycle. I just wanted to understand where we are at. Are we we're just getting into it? Are we midway through? And when do we get out of it, the microfinance bit? Second is housing finance, which seems to be kind of everyone's favorite. Strong momentum and very low NPLs historically as well. What's your view there? And I think you've liked CV financiers about a month and a half ago when we spoke. So just wanted a quick sense on these 3 segments.
Okay, so on microfinance, I think we are clearly mid-cycle. I think there is more pain to come probably this quarter. Having said that, even if credit costs peak out, I think growth could remain challenged for some time because there has been clear over-leveraging for customers in that segment, and that will take some time to wash out in the system. On the unsecured loans more broadly, I think you should see peaking out of credit costs in Q2, starting to decline Q3, but I think again growth will remain challenged for the broader unsecured piece, I think going into next year. On housing finance, I think we remain constructive. Basically, what you're seeing here is as property prices appreciate, it does 2 things. One is collateral values rise, which means that your credit costs actually come down. Obviously, with the rising property price, nobody wants to default on their home loan or even a LAP loan. And the second is obviously for the same amount of loan, you're disbursing higher value. So housing finance from a cyclical perspective, given the underlying sector, looks much better placed from a growth and from a credit cost perspective. So that's be the view. On CV financiers, we think they are indirect plays on the capex story, which we like more broadly, and obviously they also benefit from being a fixed rate book in an environment where rates fall. You could potentially get margin expansion. So CV, you get again, we think growth will be better than what markets think, and I think more importantly, there is potential of margin improvement and credit cost remaining benign. So CV, to our mind, CV financiers, especially in the NBFC space, do look very interesting to us.
Yeah, Saurabh, you are also the real estate analyst, right? You track that space as well, and that is an important part of the entire, such an important part of the entire mix. It supports so much else. That cycle remains as solid as ever. There was a little bit of a slowdown maybe in the sales in last quarter, but just a quick overall view there.
Yeah, so we think we are in the fourth year of a typical 7 to 8 year upturn. We are probably mid-cycle. Inventory levels continue to remain low in the market. Prices continue to move up. And eventually, obviously, after 4 or 5 years, we'll probably see a downturn. But I think given the conditions today in the market on inventory levels, given the fact that prices are appreciating, which basically gets some amount of pent-up demand also to come in, some amount of investment demand to also come in, we think the cycle will remain supportive till you see supply levels go up substantially. I think the cycle will basically break up on supply or debt. We don't see that risk today.
Sort of finally, to sum it up, and I'm going to come back to financials. So banks may see a slight crimping of margins, and then we need to see if they can keep sustaining strong loan growth. Some argue that maybe the best of the asset quality is also behind us, and the curve goes down from here. In this environment, are you, as an investor, are you better off for looking at banks as an investment, or should you go back to, let's say, capital market plays or insurance or asset managers, because some of these have been, or even wealth managers, because some of these stocks have been fantastic wealth creators already?
So yeah, I mean, they tie to this broader thesis of saver to investor, that the money is moving from savings accounts to some of these plays. But I think from a large cap bank perspective, yes, some of this is also priced in. The valuations are pretty reasonable for the growth on offer. And I think if you are a value investor or valuations do dictate some amount of your investment outlook, then large cap private banks do look good. They are still taking deposit market share. They're still taking credit market share. I think from a capital market businesses, they do look interesting from a growth perspective, but I think valuations are quite heady at about 35 to 45 PE at this point of time. And there is obviously this risk of some, if market were to tail off, I think the operating leverage could play on the negative side. Okay, so some of the large private banks remain your preferred bet. Yes. Got that, Saurabh. Thank you very much. Very insightful conversation. Thank you for joining us on the show today. Thank you, Surbhi. Thank you for having us.
Thank you. Well, with that, it's back to the studios.
Thanks for that, Surbhi. Well, the markets actually have turned around. We've moved into the green. We started off with a cut of around 20-30 points. Now we're up 20-30 points. A good times from a bullish perspective. We'll slip into a short break, come back, continue our focus on markets. We'll also dip into the commodity space. Manisha Gupta is waiting for us. Welcome back. Markets holding with strong gains. Metals are leading the way, but I think HDFC Bank, just pull up the intraday chart. That will sum up the first 45 minutes of trade. HDFC Bank opened up a little bit in the red. Dip got bought into, helps the Nifty higher, helps the Nifty Bank up as well. Midesh Thakkar is back with us. Midesh, well, the markets are trading with mild gains. Your view on the index, levels to track, as well as your fresh picks at 10 a.m.?
Yeah. So, I think on the index today looks like to be more of a consolidative day. Though I think both the markets are mildly positive, but overall it could be a day when you would want to buy on declines. One, two. I think on the stock side, Nigel, you were just pointing on metals, and I have some recommendations over there. Tata Steel is a buyer disclaimer that I have some call options positions over here, so there's vested interest, but it looks like it reversing from a sideways consolidation could do very well. So keep a stop below 150 for half year. Look for a target of around 167 to 170 on the upside. And the other stock which I like is Steel Authority. That's a buy as well. Again, disclaimer that I have some position in cash markets too. Again, there's some vested interest, but it's given a gap kind of a breakout. Could see good continuation. So we'll recommend a stop below 130 here and a target of around 143 to begin.
All right, thanks a lot for that, Mitesh. But let's focus on the metal space then. China has announced a slew of measures which can be positive for metals. They say that the PBOC will cut the reserve requirement ratio, that's RRR for banks, by 50 basis points, but they stopped short of giving any kind of timeline for that cut. They've also hinted there could be another RRR cut by around 20 to 25 basis points by the end of this year. There are a few more highlights, so let's put that up for you. They'll cut rates on existing mortgage loans. They'll also cut 7-day reverse repo rate by around 20 basis points from around 1.7% to around 1.5%. And they'll cut down on the payment ratio for the second home to around 15% from 25% earlier. Phil Capital, well, they maintain their positive stance on metals. Their top picks are JSW Steel as well as JSPL from the ferrous pack, Nalco and Vedanta from the non-ferrous pack. And they are recommending accumulating NMDC and SAIL. Both of them have seen a sharp correction from the recent peak, but they believe accumulating these stocks in a staggered manner could work well as well. So explains why metal stocks are higher. But Manisha joins us to give us a complete wind down in terms of what's going on in the commodity index. Manisha, take it away.
Well, thank you for that, Nigel. I'm looking at raw sugar prices because this is yet another sector which has continued to gain up. Well, actually, when you look at the commodity index in its totality, whether it's precious metals, energy, most of agriculture also seems to be surging up. So for raw sugar prices, we are trading at around $22.5 a pound there. Prices are trading at a 5-month highs. And also, this is because of the concerns that you have coming in from Brazil, where the wildfires have damaged almost 5 million tons of cane crop there. And that tells you that the overall Brazil sugar output for 2024-25 now is forecasted down at around 39.2 million tons. Well, if you look at the global markets as well, the International Sugar Organization tells you that they are looking at a higher deficit this time around in this year. Last year was 200,000 tons. This time around is expected at 3.5 million tons. That also has been aiding sugar prices. For the overall markets, it is also to do with the high crude oil prices and the expectation that you could be looking at more divergence, especially in Brazil, from sugar to ethanol supporting prices. For the Indian markets, it's an expectation that the minimum selling price of sugar could be raised, and also the ethanol pricing for the new season is yet to come in. Currently, we are looking at lower numbers there. When it comes to blending, though, that has continued to stay on a higher side. In an accumulative manner from November 2023 to around August 2024, the blending stats at 13.8%. And when you look at the month of August 2024 itself, the blending stat stands at 15.8%. So we are looking at stronger numbers onto that one as well. Industry clearly has been looking at long-term policy on ethanol blending. So that is something that you could be looking at as well. And then, of course, when you look at the numbers itself in sense of Indian ethanol capacity, well, that is the prices that we stand at currently. And the industry is asking for nearly 5 to 7% or more of an increase onto that one. The industry also is looking at the overall capacity, which has seen quite an increase, really. So when you look at the Indian capacity in 2017-18, we were at around 517 crore litres. In 2023-24, that number has come into almost 1,600 crore litres. So strong numbers coming in from that one as well. Markets are looking at further gains in sugar prices, given the fact that internationally we are looking at a supply deficit.
All right, Manisha, thank you very much for that. So that's commodities in focus. We're going to take a quick commercial break here. Up next, it's our segment. It's the economy. Lata will be speaking with Suresh Ganapathy, banking analyst at Macquarie, to focus on financials and what next year. Stay tuned.